Happy New Year, pair traders. We are here to look at the December 2018 trade of the month for the US top 30 equities pairs for Pair Trade Finder Pro. And today we're going to be looking at a pair that delivered a really nice trade, which is IQVIA versus PRAH. And here we had an entry signal on the 30th of November at minus 2.4 standard deviations. So what we're going to do in this quick video is to take you through a detailed trade analysis when you get that entry signal to determine whether or not you would have taken it, and if so, what the results would have been. And what we can see from this trade is that we had a very nice trade of over $900 of total net profit in 17 days, which is over a 22.8% return on CFD margin in those 17 days. So that's a very nice trade and a very quick trade. So let's have a quick peek at where that came from and whether or not we would have taken it had we seen the signal at the time. So first off, where did we get the trade from? In the ticker spreadsheet that you will download when you subscribe to PTF Pro, there is a US one, NYSE, Amex, NASDAQ. In medical laboratories and research, these are where these two companies are, IQVIA and PRA Health Sciences. PRA is about 13 billion market cap. Let's go back to that. About 6.5 billion market cap, and IQVIA is about 24 billion of market cap. They both have lots of average daily traded volume, so you've got lots of liquidity. And if we jump into Pair Trade Finder, we can talk a bit about these companies. So IQVIA, you can see, is 23 billion market cap, beta of 1.3. PRA is about 6 billion market cap, beta of 1.0. And what do? They provide integrated information technology enabled healthcare services in all over the world, basically. And they do commercial solutions, research and development solutions, integrated engagement services. And PRAH does basically the same thing. It's a contract research organization, and it provides outsourced clinical development services to the biotech and pharma industries worldwide. Okay, so they're providing the exact same thing. This one's 1976 in Raleigh, North Carolina. This one 1982 in Durham, North Carolina. So one's about double the size of the other, but they're very similar companies. You could look quickly at their statistics to see how the market is valuing their cash flow streams. You got an EV to EBITDA of 18 on IQVIA, and about 16.7 on PRA Health Sciences. So the market values them in a very similar manner. They have similar betas. They have similar sizes. Importantly, they are in the same industry subsector on the U.S. exchanges. So the only thing not as good is that you got a NYSE versus a NASDAQ, but there's another thing we like, which is that the share prices are pretty close to being similar. So from a ratio point of view, that makes it a better ratio to trade than one that's very, very different, say 100 versus $1. So that's a quick look at the fundamentals and the profile of the two companies. So we had already done that work for you when we made the top 30. Those have already been chosen. So let's go now to how this pair performed in the past. So why did we choose it in the first place? You can always just right click on the pair in my watch list and pull up backtest results that caused us to put this in here in the first place. So in the last 3 years there were 12 trades. Correlation is 63%, co-integration of 0.95, so it is co-integrated. Compound annual growth rate of about 20%, max drawdown of under 10%. Did over 7,000 of net profit and about 600 average net profit per trade, and 83% were winners. Very, very nice equity curve here, bottom left to top right, sloping, and you can see, at least for the last year, the ratio has been very much non-trending, back and forth over a horizontal line. So that looks like a great pair to trade on the basis of the back test, plus the fundamental analysis is why we chose it in the first place. So one thing we also check when we look at these pairs is to look at the price charts, the relative performance chart, just to see visually that co-integration and whether we're getting what we want. And here we can see PRA versus IQV. You can see that they separate and come back together, and they separate, they come back together, they separate, hopefully come back together. That's the co-integration in action. You can also see correlation here. But really you want to make sure that when they go apart, that they come back together. And you can see that visually on this chart. And so that also looks very good. Now the signal was generated on the 30th November, so first thing we have to do is check news, check earnings dates, and check dividends. So let's do that quickly. First thing here is to check news, see whether we have a reason why that signal was generated and whether it is a fundamental value-driven reason which would cause us to reject the trade. And when we look at the press releases of PRA Health Sciences, we see that around that time, 30th November, the closest was there was a general news item which doesn't really affect the value of the company, and then before that it was 1 month before when third quarter results were issued. So given that this signal happened a month later, there is no news from PRA or earnings that would have caused the signal. So then we jump over to IQVIA, and what do we see? This is what caused the signal. So on the 29th of November, IQVIA announced the launch of a secondary public offering of common stock. And that is essentially a number of the existing shareholders decided they wanted to sell out. A lot of them are venture capital firms, and they wanted to monetize their private equity investment or early investments. And so they did a secondary public offering. That was announced on the 29th, priced on the 30th, and done on the 30th. That doesn't change unless you believe that, founding shareholders or VCs that had come in wanting to leave the capital, unless you believe that that's a negative signal for the company, which I don't necessarily. It could just be that they want to get liquidity and book a very nice gain, which is what they do for a living, VCs and private equity firms. So I don't see that as a fundamental negative. I just see that as natural or normal business activity of private equity and venture capital. Is there any fundamental change? No. What there is a liquidity change. So all of a sudden, a bunch of shares equal to about 3% are coming to market in a secondary and have to be absorbed. And so that was enough to cause a blip in the pricing. And we'll see that if we look at our pair charts. This is the 30th of November close. And I guess some of the news came out earlier that this was happening. And this caused IQVIA's shares to weaken and cause a signal to be generated. Okay, so that's where the entry was. It's also at an extreme below 30 on the RSI, so we like that. That shows that it's probably not a bad time to get in from a price stretch point of view or ratio stretch point of view. So that's where the initial signal happened, and that's the news announcement that caused it, and we don't see that as a fundamental value shifting event. We just see it as a liquidity driven event, hence we would call this a legitimate signal. We also look at earnings. Earnings for both of the companies were announced a month previous, so we have at least 60 days before another earnings announcement, and so that gives us lots of time for a trade to come good. One of the things you can check when you go through those backtest results is the average days in trade for the backtest period. And we can see here average days in trade is about 25.58. So those are market days. That's about a month, 5 weeks. And so we've got at least 8 weeks before there's another earnings announcement. So we're clear on earnings dates. And then dividends, I don't believe either of these companies pay a dividend. We just quickly go to the fundamentals. Ex-dividend date, NA. So they're not paying dividends, these companies. You can see that down here, dividends and splits, NA. So we don't have to worry about dividends. So this is a clean signal. We would go back now to the pair chart review and just see whether there's anything in there that gives us concern. So again, it's at a 2.5 stretch. That's about as low as it seems to go over the last 2 years. This is 730 days looking back. So that's a nice comfortable place to be entering. We don't see a ratio breakout. We see it at a ratio support level and a minimum over the last 2 years again. So that looks like a good place to be entering if we think there might be a turnaround, and we see an extreme on the RSI, which would lead us to be also comfortable. You've got the volatility here, and it's been bouncing around a bit, but not too much. And we're right now in sort of average volatility, let's call it. So that's not a big concern either. So prima facie, this looks like it could be a good signal, and we would have taken it. So where does that leave us? That leaves us with position sizing based on volatility. Again, at about 2%, we don't think that requires any special position sizing, so we would have taken this at a full leg size. And then what were our results? Well, again, we went over that. The exit signal happened on the 17th of December at plus 0.41 standard deviations. You see it here at that close. It happened very quickly, so it's down and a quick bounce back. That's exactly what a very good liquidity-driven pair trade should look like. And we made some money as a result. The long leg lost money, $790, which is typical when the short makes a lot, and the short made $1,700 after commissions and slippage, all these numbers. The total net profit was just over $900, and that was in 17 days. And that's a 22.8% return on CFD margin. So pretty nice trade. Hope we get lots more of those, and I hope you enjoyed this trade review. Happy trading, everyone.